Let's dive right into this explainer, where we're unpacking a massive global house of cards. We're going to look at how seemingly isolated events around the world are colliding right now to create some major turbulence. And we're talking turbulence that hits both your everyday bills and your retirement portfolio. If you've been sitting there wondering why your grocery receipts are up at the exact same time your stock app is flashing red, well, you are definitely in the right place. So what do a blocked shipping lane, a weather pattern, and a Reddit meme stock frenzy actually have in common? Honestly, at first glance, absolutely nothing, right? But today we're going to connect those dots. We're linking the slow-moving, heavily physical economy, things like cargo ships and crops, straight to the hyper-fast, highly unstable digital economy that's being driven by artificial intelligence and retail day traders.
All right, let's hit part one, the persistent inflation threat grounded in physical reality. We really need to trace the supply chain dominoes causing that squeeze you're feeling.
Get this, startling data from S&P Global Ratings shows that gasoline prices in the median emerging market are a staggering 20% higher than last year. 20%! Now, why does that matter to you? Because emerging markets are the ones manufacturing and shipping our goods. So when their energy costs spike, it acts as a direct tax on the movement of quite literally every physical item you purchase. Even with the gradual reopening of the Strait of Hormuz, the operational bottlenecks and lingering risks are keeping energy-related inflation stubbornly, frustratingly high. And this perfectly captures the twin drivers weighing everything down. On one side, you've got the geopolitical threat, bottlenecks in the Strait of Hormuz driving up energy and transport costs. But on the other side, we have a huge climate threat. The U.S. Climate Prediction Center officially announced the emergence of El Niño. This weather pattern heavily impacts hydropower and agriculture. So you combine that with high energy prices, and boom, it drives up global fertilizer and food costs. It's essentially creating an incredibly heavy anchor on the global economy. Moving right along to part two, the AI market lifeline, acting as our digital counterbalance. See, while traditional goods are really struggling, the tech sector has been operating in a completely different reality. The counterbalance to all that physical inflation is a massive, highly optimistic AI tech boom. We're talking about US hyperscalers. Think cloud computing giants like Amazon, Microsoft, and Google, pouring absolute fortunes into building out new data centers. But here's the catch. They can't build these centers without a massive influx of imported semiconductors and computer components. This relentless demand is literally acting as a load-bearing pillar for emerging markets in Asia. Economies tied to this tech supply chain are actively benefiting. Countries like South Korea, Taiwan, Malaysia, Vietnam, and Thailand are being shielded from the worst of the global economic slowdown. As S&P Global pointed out, they are essentially exporting the picks and shovels for the global AI gold rush. Which brings us to part three, meme stock market volatility and the illusion of stability in South Korea. Let's zoom in on South Korea. They have been riding this wave to become one of the world's best-performing major equity indexes. But just think about the sheer concentration of risk. In South Korea's benchmark index, the Kospi, a staggering 60% of the entire market rests on the shoulders of just two AI-related chip makers, Samsung Electronics at 30% and SK Hynix at another 30%. That means the health of the entire South Korean stock market is essentially tethered to the daily mood swings of AI investors. And honestly, those mood swings are getting violent. Analysts are definitely sounding the alarm. Hee-Bae Chen over at Vantage Global Prime hit the nail on the head, noting that the Kospi in 2026 is starting to trade with meme-like muscle, driven by massive retail investor participation and money just flooding into leveraged single-stock ETFs. Trading these trillion-dollar tech giants has become dangerously volatile. The market structure is behaving way less like a collection of stable blue-chip multinationals and way more like a Reddit forum frenzy. I mean, normal market mechanics are being stretched to their absolute limits here. Foundational, trillion-dollar companies are swinging wildly. Samsung has actually posted 8 daily moves of 10% or more just this year, and SK Hynix has done it 11 times. Leveraged ETFs are mechanically amplifying every single tiny shift in AI sentiment into massive index-level panics. It is a highly, highly precarious situation. All right, part 4, cracks in the AI boom and a heavy foundation. Because what happens when that load-bearing pillar of AI begins to crack? Well, this is the multi-billion-dollar question everyone is suddenly asking. Is the AI bubble actually bursting? The narrative is pivoting incredibly fast, shifting almost overnight from unbounded exuberance to sheer panic. People are seriously starting to wonder if the massive spending required to keep this AI dream alive is remotely sustainable. We are seeing a rapid-fire string of negative catalysts. It's just one hit after another. Alphabet suffered its worst day in over a year, dropping 5% right after some high-profile AI researchers fled the company. Then, SpaceX saw its stock plunge 16% post-IPO amid these massive debt plans to raise $20 billion in a bond sale. On top of all that, Morgan Stanley analysts are warning that AI-related borrowing is going to surpass $500 billion. Investors are absolutely terrified that big tech is financing excessive, unproven infrastructure through massive, towering debt. Now, zooming out for part 5, the global market fallout as contagion spreads, let's look at the severe consequences of this reality check. Because in our hyper-connected economy, a tech stumble in California doesn't just stay in California. We're witnessing a literal domino effect here. Step 1. The U.S. tech sell-off sees the Nasdaq drop 2.2%. That instantly sends shockwaves across the Pacific. Step 2, because of that heavy concentration we talked about, the highly leveraged Asian chipmakers plunge, with SK Hynix and Samsung dropping more than 12%. And Step 3, that localized panic bleeds right into global index contagion, dragging down the entire world market. The resulting global market numbers paint a pretty painful picture. It's a sea of red. You've got the tech-heavy Nasdaq in the US taking a 1.01% hit, Japan's Nikkei 225 down a brutal 4.17%, Shanghai dropping 2.26%, even Germany's DAX got pulled down by 0.75%, just dragged by the sheer gravity of this global tech slide. The contagion spreads completely indiscriminately. So, as our global house of cards shakes, I want to leave you with this to ponder. With inflation persisting and the AI lifeline fraying, where is the global market's true safe haven? If the physical economy is bogged down by geopolitical strife and climate-driven inflation, and the digital economy proves way too volatile to hold the world up, where is the true security for your investments? It's a question every single investor needs to be asking themselves right now. Thanks for joining me on this explainer, and definitely keep a close eye on those markets.